Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. Welcome to our August webinar. Well, it's been another interesting month in terms of the foreign exchange market, so we'll deal with all of the developments there, and also been quite a volatile period in terms of interest rate expectations. So we'll see how much they have changed since our last call back in July. But I'm gonna plow straight on with my presentation. Lots to get through in a very short space of time. So we're going to go to the next slide, please, which is just looking at the latest batch of IMF forecasts. Now, we knew that they'd already revised up the UK numbers. They did that in mid-May. So that isn't actually a surprise. But I think it's worthwhile noting that there's, broadly speaking, been upward revisions to every economy over the course of 2023. So the expectations for growth in 2023 are all revised up. The UK much more so than other major economies. I think it's done better than basically everybody apart from Russia in terms of the upgrade to its economic outlook. But you can still see from this table on the left-hand side that numbers represent still quite a poor performance for the UK relative to that of its main competitor economies. So worse than Euroland, the US, Japan, and a lot of other major economies. 2024 is a bit odd in terms of performance. So economic performance expected to improve fairly materially in both Euroland and the UK, but worsen fairly dramatically in the US. And I'm still left scratching my head about that one. You know, the US being the world's largest economy still, how is that performing much worse? But Euroland and the UK performing much better. And if you look at predictions for interest rates, for example, then the US is expected to cut interest rates way more aggressively and yet get no real benefit from that in 2024. So I do wonder whether we've got some significant further changes that will occur to these forecasts. I personally believe that 2024 is going to be a pretty tough year for most economies as interest rates turn positive on a real basis for all of those major economies. And I think that you'll still see some struggle from the Far East. They'll still be dealing with higher interest rates and a challenging economic environment as the hangover from COVID continues to hit some of their major economies. So that's what we're expecting from an economic perspective and what the IMF is now saying. I think some of that may well inform judgments with regard to monetary policy. But if we look at the next slide, actually the predictions for monetary policy in the major economies is that we're basically at or very close to the peak for most of these major economies. So for the US, I think the markets are pretty confident now that that's the Federal Reserve done. So remember, they paused in June, they hiked again in July, but I'm not sure that last hike is enough. Sorry, was required. I don't think that last hike was really justified, or the pause wasn't justified. They should have just gone in June and had done with it. It really didn't make much sense, the decision that they took to pause and then hike again. The European Central Bank have been pretty consistent in terms of their tightening. So they've hiked interest rates now to 4.25% on the refinancing rate basis. It doesn't look as if we're going to get further rate rises from here from the European Central Bank. But both the Federal Reserve and the European Central Bank have left the door open in case the fundamental data moves in a way different to what they're expecting. So if inflation is stickier than they thought that it would be, I think they've left themselves the door open to hike again. But I think that would be determined much more by domestic inflation pressures, so higher wage growth, than it would in terms of return of higher energy prices, because the base effect of energy prices is still going to be a net drag on inflation for a few quarters to come yet. As far as the UK is concerned, we're still looking at the UK having the highest peak in interest rates of all of the major Western economies, around about sort of 5.75% up towards 6%. There is a risk that the Bank of England over tighten, and that was actually highlighted by the Chancellor's own Economic Advisory Council. So there is clearly concern in the government now that the Bank of England are operating against a backdrop of reducing inflation pressures, and we certainly see that from other elements of inflation, not the consumer price numbers. And the bank, but yet the Bank of England is still tightening monetary policy, and all of these major central banks, as I've already stated, run the risk of hiking interest rates in a rapidly changing environment as far as consumer price inflation is concerned, and also consumer price inflation expectations are concerned, and that could turn interest rates on a real basis very positive very quickly. I'm not sure how the economies will react to that. If we look at inflation in closer detail on the next slide, then you see CPI inflation is falling quite rapidly now. I thought what was interesting is we obviously had that overshoot in inflation in May from the UK, and then the June numbers undershot by almost as much. And that changed market expectations as far as sterling's concerned. So we saw a peak in sterling against the US dollar, up above 131. We saw a peak in sterling euro back in the sort of 117s, and yet we had off after the big fall in inflation, in UK inflation. We could get another quite sizable fall in UK inflation in the July numbers, as we start to see food price inflation really reverse quite rapidly. As far as the US is concerned as well, their inflation rate's now running at about 3% on a consumer price basis. In the Eurozone, it's running at around 5.3%. So we are seeing very sizable falls in inflation, but the UK is still the outlier. It has an inflation rate of just under 8% at the moment, but expected to fall quite rapidly further. And the reason that I would expect that is if you look at producer price inflation, input prices are falling now across the board, really, the exception being the US, where inflation is, broadly speaking, flat on a producer price basis. But there really isn't the impetus from the producer level to then feed through into higher wholesale prices and then higher consumer prices. So I'd expect to see those rates of inflation continuing to fall. And I said last month, I wasn't sure whether interest rates should still be rising based on weak producer price inflation numbers. But I'm more emphatic this month. I think there should be no further interest rate rises in any of the major economies. So if they do that, then they're making a mistake, and a mistake that will be paid for by consumers, paid for in terms of lower economic output. So they run the risk of forcing a prolonged recession rather than trying to engineer a soft landing. If we move on to the next slide and we look at what's been happening in the currency markets, a couple of charts here for you. I'm not trying to take Piers' job. I'm just going to emphasize here that you can see the turn in sterling when we had those weaker UK inflation numbers. So quite a dramatic shift in terms of sentiment, I think, as far as sterling dollar is concerned. But even in euro dollar as well, we are, sorry, this is a sterling euro chart rather than euro dollar. Even in sterling euro, you are seeing a shift here as well. So sterling euro is it looks as if it has peaked, and I think that that sterling euro and euro dollar, for that matter, are also likely to be heading lower. So the risk is that sterling materially underperforms, and I think that's because the markets are still pricing in quite a lot of rate increases. The Bank of England might start to row back on their predictions of much higher interest rates if we continue to get the improvements in inflation that are expected. And I thought what's also interesting is if you look at a lot of the survey data, particularly out of the UK, things like PMIs, purchasing managers indices, things like business confidence, there is an indication that both of those are heading downwards again. So weakness there suggests that activity in the coming quarters is going to be weaker, and that will also put some negative pressure on underlying inflation, again reducing the need for higher interest rates from here. So final slide is the forecasts. Or final slide before the disclaimer, that is, and the forecasts have changed a little bit, so we're not as optimistic about the prospects in the short term for sterling and the euro against the dollar. Probably a lot of the good news is already priced into both of those currencies against the dollar, and the dollar's weakness that we saw in the early stages of Q3 does seem to have pulled back somewhat. So I think that we're going to see a period of potential reversal as far as sterling dollar and euro dollar is concerned. Some dollar strength really across the board against other major currencies. Look out for is we've seen some changes as far as the way in which Japanese central bank officials are looking to try and manipulate their monetary policy. That hasn't had a big effect on dollar yen as yet, but dollar yen and dollar China, I think I referred to in the past, were moving in opposite direction to the way in which sterling dollar and euro dollar were moving. We do seem to have had a break in that in terms of all of the currencies now seem to be weakening somewhat against the US dollar or are already weaker against the US dollar. So we'll watch for the next direction here in terms of what signals things like dollar yen and dollar China can give us to see whether the dollar will continue to strengthen from here on out or whether it will start to give back some of those recent gains. If that happens, then you could expect a new phase of sterling and euro pushing higher against the US dollar, back towards 130 in sterling dollar, back towards 111, 112 in sterling euro. Sorry, in euro dollar, and so look for the signals from the Asian markets because I think that's where they are strongest and clearest in my view. So moving on, that's my disclaimer as the next slide, and then I'm very happy to introduce Piers again to run you through the latest technical analysis outlook. So Piers, thanks very much for joining us again, and it's over to you.
Hi Neil, thanks very much for that. Very interesting as ever. So if we go to the first slide, I just say this is the way that the monthly charts look at the start of August. So we're going to look at potential support and resistance levels as ever. And always remember, August is sometimes a strange month because some of the market is very thin as people go on holidays. So we'll start with the dollar index on the next slide. So this is the dollar index monthly chart. Now, on here, we've been looking each month at the Bollinger Bands and some of the Fibonacci retracements. Now, we can see that last month, price broke below the 20 moving average from the Bollinger Band, the mid-Bollinger Band. So that's a negative thing. But one thing that sort of saved it was it bounced off a line we had last month in the webinar, 99.38. It managed to rally off there and close above 101.30. So there's a bit of hope for it because it had that large spike on the bottom. But it has broken below that 20 period moving average. So really, you need to see price move above 103, 104. So the 103 comes from the moving average, and the 104 is the retracement, which has capped it for the last couple of months. You need to see price move above there to take away the negative feel. So that would be negative feel broken. But to get positive, price actually needs to do a lot more. It needs to get above 105.50, 106.50. So at the moment, it has a slight negative tone below 103, 104. I've used 101.30 maybe as a pivot this month. And while it's above that 101.30, maybe it's going to rally back up, test that 103, 104. But if it breaks below that 101.30, then I think you see a sort of test down towards that 99, 98 area again. So that's going to be key, that it doesn't break below that 97, 98 area. Because you can see there's an orange dashed trend line coming down there. It was the old base where it rallied off last month. So if it starts to break below that 97 area, then things are starting to look bad for the dollar. The strength is starting to wane even further. And that is a true break of the 20 period moving average. So at the moment, this month, use 101.30 as a pivot. Above it, maybe up to 103, 104, bit of dollar strength. Below it, maybe down towards 97.50, 98, 99, down to that area as support. So what does that mean when we look at currencies? So we go to the next slide, we look at euro dollar. Now, this is a monthly chart, and it's just worth keeping this. We had this on previous webinars. So we've been looking at the Fibonacci extension swings here. And so we look at the first move up, that move we had from the end of last year, then the retracement back down that we got into the first part of this year, then the rally back up. And you can see that it's respected that 38.2% retracement at the 110.95 area. We hadn't had a monthly close above it all year. And then last month, it tried rallying through there. It got up to 112.74, which is the 50% extension, and fell back off. And we'll see on the next slide. We're not going to the next slide yet. We mustn't say next slide. We go to it sometimes. But on the next slide, we'll see why that 112.74 was important as well. So it was the 50% extension, but importantly, it came back to close below that 38.2%. So we really, to see euro dollar go higher, you want to see a monthly close above 111, because that will take out that 38.2%. That's held it all year. We haven't had a monthly close above it. But if we go to the next slide now, we can see again another line we've been highlighting on the charts has been this long-term trend line. Now I've zoomed in a bit, so that trend line goes back further than it shows on there, but it comes in the 112s. So price has been up to that trend line and fallen off it. So now this is going to be a bit of a wide range, but you know, we've had big moves in the last few months. Last month was nearly 4 cents. At the moment, I would look for 112, the 112 area to be the resistance to watch. You need to get above that to start thinking about higher euro dollar. But on the downside, where is support? Support should be initially around about 108.60, 70. And while price stays above 108.60, 70, you're sort of in that 4 cent range, 108.60, 112.75. And I'd use probably that 110.95, 111 area from the previous slide as a pivot, just to see how it's doing as the month goes along. Where do things change? Where does this actually say, look, this retest of the trend line is a fail and we are going to go back lower? Because below 108.50 would suggest 107.75 and potentially down to that 106.80. And that would be a negative for euro dollar if we went right back down there. So start the month watching 108.60, 70, 112.75. Any breakout of those two starts to show you who's taking control. But last month isn't a very clear candle. You had a spike up to the trend line. It's come back down, but it ended positive candles. It's green. But we really need to see price above 110.95, 111 to get more excited that we're going to retest and try and attack that trend line again. Below 108.50, 60, as I say, then it's time to sort of abandon that. And this is the retest and fail of a trend line. So we'll go to the next slide now. The next slide is sterling index. So this is going to affect sterling against all the currencies. That's why it's always good to look at this. We don't have to go through all the different currency pairs, but we can know it just tells us what's going on with sterling. So last year, after the, I don't know what you call that flash crash, but it was something to do with that funny budget that came out and then wasn't a budget. But sterling collapsed down, came back up, but then we formed this morning star candle formation, which I highlighted on the charts. And it hasn't really looked back since then. It's really just been a case of going higher and higher and higher. We took out the 20 period moving average, which acted as resistance for a few months. It went above there, and where's it gone? It's gone to the top of the Bollinger Bands, and it's just walking along there. But it's interesting that last month was actually a negative month. Although it's at the top of those bands, it was a slight negative month. The month closed lower than it opened. So we could see a test lower. with the test lower, as long as the support is held by that mid-Bollinger, by the 20 period moving average, I think sterling still has its strength. So dips lower should find support by the 63 area. Now, if support doesn't come by the 63 area, you might see a test down towards 61. And it's below 61 on the sterling index that you'd start to worry, has sterling lost its strength? Why has it come down so far? So watch 63.50.80 on a monthly close basis. Any monthly close below that would open up 61, and below that would start to question, has sterling peaked? But at the moment, it's looking positive. The Bollinger Bands are shifting wider, prices going up. So at this stage, I expect dips on sterling to be bought into by the 63 area. So how does that transpose when we look at the main two currencies that we look at, which is sterling dollar? So we look at the next slide. So sterling dollar, this has been a chart we've used for months, and it's worked really, really well. So it's what I call the rule of polarity chart here. We had those periods on the left of the chart where sterling dollar always found support in that sort of 120 to 123.60 support. It broke it last year, crashed lower. Then it came back up, and we saw it act as resistance for 4 months. So that's the rule of polarity. Resistance and support swap round. Then look what happened. After 4 months of being held, it broke above it. So the last 3 months, it's used it as support. So you can see in there, it's used it as support. It broke above there, and it went up higher. So it's closed above the 61.8% retracement. So that's positive, but there is quite a big spike on it. So maybe it's just peaked. And why has it peaked? Let's look at the next slide. Hopefully that will help. So now, actually, I've got these slides in my head in the wrong order, but we'll get to another slide where I'll show why it's sort of peaked. But here, this is just looking at the Bollinger Bands, and this is the quarterly candle that we're saying about. So we said be very careful about that pink 20 period moving average. Now you can see prices spiked above it, but come back down to close slightly below it at the moment. But the quarter isn't over. There's still 2 quarters. But we've got to keep an eye on that line as the quarter progresses. Because if we close the quarter above that line and clearly above that line, that'd be a real boost, I feel, for sterling dollar. And then that will switch from resistance to support. But if we go to the next slide, we'll look at it on the monthly basis. Now, this is the slide I was going to show. Maybe this shows why, and it's one of the reasons why sterling dollar peaked. Neil said something earlier, some sort of inflation number, I think, or something, but I don't think that's quite the case from a chartist point of view. I would say price went up and it stopped at the top of the Ichimoku cloud. So you can see that yellow cloud, that when the spike got to the top of that, it fell back off. So we've seen price come off the top of that cloud and come back down. But it's not the only reason why I feel that it stopped at that area. So we now can see that we're above the 20 period moving average quite clearly. So that area switches in as support, the 124.30 area. So we know that while we're above 24.30, potentially this could see dips down there, find support and go back up. They might not get all the way to 124. Below 124.30 on a monthly close would suggest something's changed. And then the market's changed its view on either sterling or the dollar. But if we go to the next slide, this is the slide I was thinking of in my madness. So if you look at the extension swings, and we've been putting this on the weekly charts, if you get my weekly charts, when we got up towards that 131 area, it was an extension swing point. And that's where it's come back off for me. It failed at the top of the Ichimoku cloud and an extension swing. So if we look at this chart, a monthly chart, and just say, right, let's look at this on its own. Same thing as euro dollar. We take the rally where it started the end of last year. We do the pullback into the start of this year, then look at the extensions going up from there. all those blue circles, you will see that each month they've used these extensions as support and resistance going through. So I would keep watching those as support and resistance. The other point on this chart is you had the downtrend, the old downtrend, which we had of 2021, 2022, is the orange dashed line going down the chart. You can see that broke last month. Last month, we got a close above that trend line. And what does that mean? It means that people who were trend line sellers and sold the trend line had to cut out. You know, they accept it was wrong, it's not going to hold. And price rallied as they had to buy to cut out those sales. And also new people were buying because they see it as a break of the trend line. You also had a black dashed line going up, and that's the new uptrend. So while you're above that uptrend and above the old downtrend, and they sort of come in quite close, you should really look for continued sterling dollar strength. If it breaks below there, then this was just a peak out of it. But on here, we have the 38.2% extension round about the 126 area. So 124, 126, that's going to be an area where sterling dollar should find support. Rallies back up. Where are we going to find that resistance? Well, we're probably going to find the resistance around the 131, maybe up towards 134 if it gets that high. So those are sort of areas I'd watch going forward. And then if we go to the next slide, we have euro sterling. And in fact, I'm going to miss this and go to the next slide because they're both the same thing. I do sterling euro and euro sterling. Neil tells me more people watching this presentation want sterling euro. If that's incorrect, all please email in. I'll do euro sterling. But I'll just go through the sterling euro. And if you're interested in euro sterling, it will be in the slide pack when it's sent out. So again here, if we look at these extensions, you can see the price that's been holding this extension has been the 38.2%. We had a downtrend going through 2022 and 2023. That broke earlier this year. And you got a very positive move. But where did it go up to? It went up to the 20-period moving average from the Bollinger Bands. And that held it 2 months ago perfectly. And price tried going higher and lower last month, but closed perfectly on it again. But this month, you've closed slightly above it. But you quite haven't got that confirmation. It's like when you've asked someone out and you're waiting for them to say yes. They haven't quite said yes. Because to get that confirmation, you want to be above the 38.2%. And price is just slightly below there. So if you get above that 38.2%, then I would look for a move higher towards the 50%. So very important levels. So a monthly close above, let's say 117.65 would open up a move towards 118.35 and potentially up to 120. So it could be good moves here. So you just want to see that that holds. Where would I say support is? I think support should be probably around the 114.60 area. If you start to get below 114.60, I'd worry. But 114.60, 115.20, that sort of area should be support. Only back below there has sterling euro lost its mojo. And the next slide is the most important slide, the disclaimer. And that's me done. Hopefully it sort of helped you with thoughts on what's happening.
Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.